Hey guys, this is Riado and welcome back to the channel. This is part 2 of my Enphase stock analysis, and if you're interested in watching part 1 where I talk more about the growth and profitability of the company, you can find the link to part 1 in the description down below. With that out of the way, let's get into the second part of the analysis. Turning to the balance sheet, Enphase is in a strong financial position with cash and short-term investments of about $1.8 billion as of Q1 and debt balance of about $1.3 billion, which puts its net cash position to about $500 million. And as you can see, its net cash position is starting to pick up over the last few quarters, and the reason why net cash hasn't grown much in 2021 and 2022 is because of the fact that the company made 7 business acquisitions in those 2 years alone. So if there aren't any more acquisitions in the pipeline, we may see net cash position increasing from here. At the same time, the company has a current ratio of about 3.4 times, which is healthy and liquid. Net cash should continue to grow as the company is already free cash flow positive. In fact, Enphase has very strong free cash flow margins. In 2022, free cash flow was $698 million, which represents a 30% free cash flow margin, and in Q1, free cash flow was $224 million, which represents a 31% free cash flow margin. And of course, because of this solid cash generation, Enphase is able to acquire other businesses, which it has done so aggressively over the past 2 years as the company enhances its consumer and installer platforms. Management also mentioned their capital allocation strategy moving forward. The first priority for the company is to make sure that the company have plenty of cash for the needs of the business or the day-to-day operations of the business. Management also spoke about M&A opportunities, which is its second priority, and the company is looking in the areas of batteries, power conversion, software, home energy management, and EV charging. And finally, management also mentioned that they will be buying back shares assuming the share price is below conservatively estimated intrinsic value. So far in 2022 and in Q1 this year, Enphase has not bought back shares, and the last time Enphase bought back shares were in Q4 of 2021, specifically in the month of December. So if we look at the stock price in December 2021, we can see that the stock is trading in the range of $250 to as low as $180. So given that shares have fallen by 50% from the all-time highs as well as below the levels in December 2021, I expect Enphase to buy back shares quite aggressively in the next few quarters, especially if the stock goes below $150 per share. But aside from that, I would love to see Enphase pay down its debt given that the company is self-sufficient, and I don't really see a need for the company to hold debt on its balance sheet. Regardless, Enphase has a strong balance sheet and cash flow generation, so nothing to worry about here. Turning to the outlook of the company, management provided the following guidance. So here you can see guidance in GAAP and also in non-GAAP, but I'll just be analyzing the GAAP numbers as I don't really look at non-GAAP measures, but it's there just for reference. So management expects revenue to be about $700 million to $750 million, which is a 37% year-over-year growth from the midpoint guidance, and you may have noticed that this is a steep deceleration from Q1's 65% year-over-year growth, which is the main reason why the stock reacted so negatively following Q1 earnings release. In this revenue guidance, management also expects shipments of 80 to 100 megawatt hours of Enphase IQ batteries, which if you take the midpoint guidance is actually a 32% decline year over year. So again, we're going to see the batteries business continue to struggle in this high interest rate environment. Moving on, GAAP gross margin is expected to be 41 to 44%, and the midpoint guidance of about 42.5% is actually slightly higher than the last year's figure of about 41%. So the increase in margin is a good indicator that the company is gaining economies of scale. GAAP operating expenses is expected to be $155 to $159 million, which is roughly a 26% year-over-year increase, and this figure is actually lower than revenue growth, which means an improvement of the company's operating margins year-over-year. And finally, the company also expects an effective tax rate of about 21 to 23%. So revenue guidance is pretty underwhelming, probably due to high interest rates, the NEM 3.0 transition, as well as tough year-over-year comps, which is why the stock sold off after earnings. The CEO also mentioned that demand will unleash only when interest rates return to normal. But the Fed also mentioned that 2 more rate hikes are likely coming, so that could mean additional short-term headwinds for Enphase. On the bright side, margins are set to improve despite the slowing growth, which means profitability is sustainable and improving. But that aside, I think the revenue guide is pretty conservative despite the gloomy remarks from management. As you can see here in Seeking Alpha, which shows Enphase's actual versus consensus revenue numbers, Enphase has an excellent track record of beating analyst estimates, which is why I think Enphase will do just fine or maybe better than expected moving forward. But whatever it is, Enphase still has a long growth runway ahead. For one, according to the IEA, solar PV installed power capacity, which is the yellow line right here, is expected to become the largest source of electricity by 2027, while other sources of energy such as coal and natural gas are expected to flatten and decline over time. In addition, according to Bloomberg New Energy Finance, energy storage installations are projected to reach a cumulative 411 gigawatts by the end of 2030, which is a 15-fold increase from 2021. Furthermore, according to the Solar Energy Industries Association, storage is increasingly being paired with all forms of solar module. As you can see, solar plus storage systems only account for 10% of all distributed solar systems in 2022, and that figure is expected to reach nearly 30% by 2027. In other words, more consumers will likely opt for solar plus storage solutions in the future. And Enphase is already capitalizing on this opportunity by expanding its ecosystem of products and cross-selling them. And as you can see, Enphase is increasing its share of wallet per home. So back in 2019, its potential per home was only $2,000, which consists of only microinverters. But as the years go by, Enphase introduced more products to enhance the Enphase energy system. For instance, with IQ batteries, the potential per home increased to $9,000, and today with other products such as IQ load controllers and EV chargers, Enphase's potential per home is now close to $12,000. Put simply, the trends are very clear. Solar PV and energy storage adoption will only continue to grow from here, and this will be a massive tailwind for Enphase in the long run. And Enphase's ability to innovate new products, expand the ecosystem, and improve monetization for each home is proof that the company has a massive market opportunity ahead. And not forgetting to mention, there are numerous government policies that support solar system adoptions, including the Inflation Reduction Act, which was enacted in August 2022. So through the IRA, the federal solar investment tax credit of 30% has been extended until 2032, allowing homeowners to save 30% of the cost of installing a residential solar system in the US. At the same time, the IRA also includes the new Advanced Manufacturing Production Tax Credit, which incentivizes clean energy component sourcing and production in the US. And for Enphase, the IRA provides for a tax credit on microinverters of 11 cents per alternating current watt basis. That said, the investment tax credit for consumers and production tax credit for suppliers will push demand for solar plus storage systems to new heights, as you can see right here by the dark blue bars, and as such, favorable policies like this will boost Enphase's outlook. On the other side, there's the California NEM 3.0, which reduces the average export rate by nearly 80%, so that means less incentive for homeowners, which is likely to decrease demand for solar PV systems in California. And given that California is Enphase's largest market, it is no surprise that investors are concerned with this new policy. As you can see, NEM 3.0 is expected to decrease installations in California by nearly 40% in 2024 and beyond, but on the bright side, installations in other states is expected to continue to grow over the next few years, which is still going to support Enphase's growth. Now let's take a look at the valuation of the company. Looking at the stock price, we can see that Enphase is down more than 50% from its all-time highs in late 2022, likely due to high interest rates, NEM 3.0, as well as poor guidance. But the question is Enphase worth investing at these levels? If we look at its EV to revenue multiple, we can see that Enphase is trading at an EV to revenue multiple of just 8.3 times, which is back to its pre-pandemic levels, and it's also a significant discount to when the stock traded at more than 30 times its sales. Of course, it's not as low as it was back in 2019, but the company is much bigger and much more profitable than ever before, so the higher valuation multiple is reasonable. At the same time, its PE and price to free cash flow ratios are trading at 3-year lows, at just 49 times and 29 times respectively. And as you can see, valuation multiples are trading at a massive discount, which looks attractive from an investment standpoint. But if we compare Enphase to its peers, it gets even more interesting. As you can see on the chart on the left, I've included PE ratios of its closest competitors, SolarEdge and SunPower, which both have PE ratios of more than 70 times compared to just 49 times for Enphase. But here's the interesting part. Enphase has a much higher ROIC, or return on invested capital, than the other two companies, and higher ROIC means higher cash return to shareholders, and an ROIC of above 20% is usually considered excellent. Furthermore, Enphase has higher growth rates than its peers, as you can see right here. So clearly there's a huge disconnect in fundamentals and valuations among these three companies. And just a quick peer comparison tells me that Enphase is significantly undervalued given its superior growth and ROIC. So this is really interesting to me. If we head on to Seeking Alpha again, we can see that Wall Street analysts are quite bullish on Enphase with an average buy rating. And the company also has 18 strong buy recommendations, 8 buy recommendations, 8 holds, and just 1 sell. And if we scroll down, we can see that the average price target is about $242, which represents an upside of 45% from current prices. The highest price target is about $317, and the lowest is about $165 per share, which is where the current price is trading at right now. So overall, Wall Street expects more upside than downside for Enphase stock. I've also did a DCF model of my own just as a sanity check to analyst price targets, and as you can see, here are my key assumptions. For revenue growth, I've used analyst estimates for the first 3 years, and then I'm going to gradually drop to just 12% by the end of 2032, and I think this is very conservative given the rapid solar adoption that we're seeing today. For cost of revenue, I expect the company to gain economies of scale, so I expect cost of revenue as a percentage of revenue to drop over time to just 53.5% by the end of 2032, which translates to a gross margin of about 46.5%. I expect the same thing for operating expenses, which is going to improve as a percentage of revenue over time to just 16.4% by the end of 2032, which leads to an operating margin of about 30%, as you can see right here. For income tax expense, I will set it at a constant rate of 20% per year. Depreciation and amortization is going to be constant at 2.2% as well. For stock-based compensation, I expect it to drop over time to just 3.5% of revenue, which is around the same levels that we see in 2018 and 2019. And for both capital expenditures and changes in net working capital, I'm going to set it at their 5-year averages, which are 2.4% and 0.6% respectively. So based on all these assumptions, I expect Enphase to reach a revenue run rate of about $12.9 billion by 2032 with a free cash flow margin of about 28%. And keep in mind that Enphase has a free cash flow margin of about 30% currently, but I do expect competition to put pressure on margins over time. So that is why I set a lower long-term free cash flow margin of 28% just to be conservative. And just for reference, here is what free cash flow will look like if share-based compensation is not added back into free cash flow. So based on my projections and based on a discount rate of 10% and a perpetual growth rate of 2.5%, I arrive at an intrinsic value per share of $228, which is slightly lower than the average analyst price target of $243 a share. That said, my price target represents an upside of about 37% based on the current price of $166 a share. Personally, for mid-cap growth stocks, I would like a wide margin of safety of at least 40%, which brings my wide margin of safety price to about $137 a share. Also, if I use free cash flow excluding share-based compensation in my calculation, the intrinsic value per share drops to $186 per share, which also shows that the company is currently undervalued. But I prefer to use the traditional free cash flow metric and then use a large margin of safety to determine my buy price. So yes, based on my DCF model, I think Enphase stock is quite undervalued, but again, I'm not buying the stock yet as it has not fallen below my margin of safety price of $137 per share. That said, it seems that institutions have not been buying shares of Enphase despite the recent fall in share prices. However, they have not been selling the stock as well, maybe just a little bit, so it looks like institutions are neutral as a whole. On the other side, management seems to be quite bullish after the recent drop as they bought $6 million worth of stock in Q2 alone, which is probably the first time management are net buyers of the stock. So as you can see by the red bars right here, management have been aggressively selling Enphase stock and just recently bought the stock in Q2, so that could be a boost of confidence for investors. With that said, I do think there are some catalysts for Enphase stock, namely expanding margins, re-acceleration of its battery business, strong international growth, better than expected growth, as well as interest rate cuts. But despite all these catalysts, I do think there are further downside for Enphase stock. And here's why. First, the markets have been rallying like crazy, but Enphase did not participate in the rally and instead went in the other direction. And I'm expecting some sort of pullback in the broader markets in the next few weeks or maybe months. And if that happens, I expect further downward pressure for Enphase, and that could mean retracing back to its major support of around $120 level right here. Secondly, from a technical analysis standpoint, it looks like Enphase stock could continue its downtrend. First, we have the uptrend line right here, which have been broken down due to the post-earnings sell-off, and the stock tried to recover but is then rejected at the same trend line. And then if we draw another line right here, we can see that the stock is following a downtrend line, and it looks like the stock has recently been rejected again a few days ago. So because of these rejections, I feel like the stock will head downwards to around the 130 level, which is the next support in my opinion. Before we wrap up the video, let's quickly talk about some of the risks with investing in Enphase. First, we have concentration risks. According to the company's annual report, one customer accounted for 37% of total revenue in 2022, which was up from 34% in 2021. So the rising concentration could be a problem if we see this customer facing its own company-specific challenges, so just keep that in mind. Next, we have competition, and as you may know, the solar industry is very competitive with players like SolarEdge, Huawei, Tesla, and so on. Just for comparison, I've included Tesla's solar and storage operating metrics, and as you can see, Tesla's solar business is way smaller than Enphase's solar business, since the IQ microinverters are more flexible as they are compatible with all solar panels, while Tesla's solar roofs are standalone products. But on the other hand, Tesla's energy storage business is much larger than Enphase's battery business, and I think this is due to the fact that Tesla serves more of the large-scale projects, while Enphase leans more on the residential side. That said, growth for the Enphase battery business on the commercial side may be limited given Tesla's dominant position, but the point is, competition is fierce and that may slow down Enphase's growth. At the same time, as the solar and energy storage industry matures, components such as microinverters may be commoditized, which means price competition for Enphase as cheaper alternatives flood the market. That means Enphase would need to cut prices, which of course is going to hurt the company's gross margins and ultimately its overall profitability. But for now, it seems that Enphase has strong pricing power and customers are willing to pay for the premium, as seen from its improving gross margins. But moving forward, we need to carefully track gross margins, because if gross margins go down, it's a strong indication that demand has shifted to competitors. The final risk, in my opinion, is changing regulation, monetary policies, and government incentives, which could negatively affect demand for Enphase products. We saw how rising interest rates put a strain in consumer demand for IQ batteries, which are already very expensive, and we also saw how NEM 3.0 is likely going to reduce future solar installations in California. And what happens if the government suddenly withdraws the 30% solar investment tax credit? I think that will be a huge blow to the solar industry and Enphase. So these are risks worth considering. So to wrap up this video, I think Enphase could be a really attractive investment if investors want exposure to clean tech, given its technology, high switching costs, and cost advantageous moats. The company is growing rapidly, has superior margins, and has a long growth runway ahead as consumers and businesses all over the world transitions to sustainable renewable energy. The fundamentals of the business remain strong, and although the company is facing some near-term challenges such as high interest rates and NEM 3.0, it is clear that solar adoption will continue to grow day by day, which is going to be a long-term tailwind for Enphase. In addition, the 50% sell-off provides a great opportunity for investors to accumulate shares today, but for me, I prefer a larger margin of safety. That said, I do expect some more downside for Enphase stock given how frothy the markets have become, and so I'm staying on the sidelines, but nonetheless, Enphase is probably going to be my next buy. So, what do you think about Enphase stock? Be sure to let me know in the comment section down below. Otherwise, that's all that I have for you today. If you have enjoyed the video, I would appreciate it if you hit like and subscribe. You know, I take a lot of time and effort to make these videos, so any support from you would be amazing. As always, I appreciate you and I hope you have an amazing day. Thank you, and I'll see you guys on the next one.